In this video, I'm going to give you my thoughts on the UK economic crisis by looking at the indicators, how this happened, and what the future may bring, in hopes that it will show you my investment thesis in what and how I plan to invest, and more specifically, what opportunities there may be. And if you find this video in any way useful, please drop me one of these to support the series. I feel that it is very important to disclaim that I am just some guy on the internet talking about stocks, economics and investing, and I look about 13, so do not take this as financial advice. I hope that this video can give you perhaps an alternative view or an insight into how I personally invest, and as usual, all of my links to my research will be in the bottom of the description down below so that you may look into it further. The UK has entered the deepest recession since records begun, and furthermore is the worst performing of any major nation, well, except for Spain. Whilst in the first quarter our GDP, or gross domestic product, had fallen by 2.2%, this means that our economic output, or everything that we produce inside our borders, had lessened. In the second quarter, it actually worsened and we had fallen by 20.4%. And this means that we had officially entered a recession. As to officially enter a recession, you need 2 consecutive quarters of economic retraction. Now that we've established that the UK is in a recession, it's worth talking about how this happened. So I'm going to explain that right now. And unless you've been living under a fairly sustainable rock that does have no internet connection whatsoever, then you likely know we are in the middle of a pandemic. This has meant that in order to keep a balance in our healthcare systems, that we have had to, well, put in place things like lockdowns and curfews to therefore reduce the infection chance. This pandemic means that people are less likely to leave their homes, which therefore leads to a lower amount of footfall in high street stores, which is basically the amount of people entering a store or currently shopping at that given time, and that is the footfall index, and this applies for high street stores, retail parks and also shopping centres. An example of these high street stores perhaps could be a clothing retailer, which would have been regarded as non-essential and therefore forced to have shut during the lockdowns or had restrictions on their opening hours. This has meant that less people would be going inside of these stores and therefore they wouldn't be receiving much money and people would be as a whole spending less money. And if we look at the footfall index graphs ourselves, we can see that after the first lockdown, obviously, whilst things were recovering for the high street retail parks and shopping centres, it was at a very slow pace. And then just as the curfews were set for the pubs and bars, it slowly started to decrease again up until the second national lockdown of England. I think the important trend to take from this is that the recovery will likely be excruciatingly slow and not like a bounce back, which you may see in some stocks on the market. This doesn't sound that bad, but it's important to realise that our economy is made up by a majority of consumer spending. In fact, household consumption is the largest element of the UK GDP, taking up 62% in 2019. And if we look at the household savings ratio, we can see that in the second quarter of 2019, it was only 6.5%. Then in quarter 2 of 2020, we can see that this had rocketed up to 28%. This means that more people are staying at home and obviously spending less money and therefore saving, which means that less money is going into our economy, leading to a decline in GDP. Furthermore, this is exactly why the central banks had lowered interest rates, so that it would decrease the amount of people willing to save money and therefore they'd either invest it or spend it. Furthermore, this can go to the businesses as it is cheap liquidity and it effectively can stimulate the economy. In a more ideal or perfect economy situation, we would likely have a perfect balance between all of the different sectors. But in the UK, this is far from reality. Our economy, or GDP, is heavily weighted to services. And in fact, in 2019, we had a 71.26% weighting to this services portion. And furthermore, we can see that there's a trend going back from at least the 1970s in which we had reduced our own exposure to manufacturing and industrials and therefore increased to services. This means we rely upon various different services such as tourism, which had actually taken up quite a significant portion and contributed £213 billion to the economy in 2017. But the pandemic isn't the only impact to the UK, and that's where Brexit comes into things. For an example, with such as tourism, we could see that Brexit could mean that there is more costs of travel, visa applications could take longer, and this could lead to less people willing to travel to the UK. This very much depends on how Britain exits the EU, and likely by the time this video is up, or as you are watching this, things may have changed. We may have a deal, we may not. But at the moment, that has certainly put stock prices down, as the stock market doesn't like uncertainty. If we have no deal or a deal, at least then there's clarification in which answer there is. But at the moment, since there isn't quite an answer, there's a lot of debates going on, the stocks have been priced down. And that's reflected when you compare it to other indexes. If we look at the FTSE 100, currently it's year to date, it's down around 15%, whereas things like the S&P 500, I believe, are up year to date. I think it's important to realise that with Brexit and the pandemic, which could have some long-lasting effects, that the UK may recover a lot slower than other nations. More recently, there is news on vaccines with 90% effectiveness, and that furthermore, the UK had managed to secure 5 million doses of the Moderna vaccine. This means that if all of the vulnerable are effectively identified and therefore they've distributed these vaccines, then we could very likely reopen our economy fairly soon. Then ideally, with Brexit coming to a clear result, as I mentioned earlier, this could certainly lead to quite a significant change in how our stock market has been priced. As Baron Rothschild famously stated, buy when there's blood in the streets, even when it's your own. And so that brings me on to the topic of how to invest into the UK. And obviously you may be thinking, okay, I'll just invest in an index fund or an exchange traded fund, as that's the easiest route. Well, easiest doesn't necessarily mean the best. For example, the FTSE 100 likely isn't the best alternative option or the best option for investors. And that's because it doesn't actually have that great of an exposure to the UK. It's simply the 100 largest listed entities on the London Stock Exchange. And in fact, a majority of these stocks are globally diverse in revenue and therefore don't give you much of an exposure to the UK economy. Whereas if we look at the FTSE 250, this is filled with more smaller and mid-cap stocks ranging from around less than £5 billion to above £1 billion. This effectively means that you will get more of an exposure to the domestic UK economy, such as various businesses that are very much present in the UK, like Greggs, and it isn't horribly weighted towards the dinosaur or the giant stocks or dying industries or old world industries in the FTSE 100 like tobacco and oil and gas. Therefore, I would personally invest into an index fund tracking the FTSE 250, such as the one offered by Vanguard or the ticker symbol VMID. They offer the lowest fees available, and if you sign up to Trading 212 using my link in the description down below, you can get a free share worth up to £100 when you deposit just £1, and that could certainly give you a head start when investing in these funds. But as a majority of you likely already know, I'm a stock picker and therefore I seek to outperform the markets, and that simply isn't achievable by investing in index funds, as ultimately you will end up tracking the markets but not beating them. So I feel that I've identified some sectors and some stocks with growth opportunities that are listed in the UK, more specifically AIM markets, and why I feel that they will grow in the future. Since there is limited footfall and therefore reduced consumer spending, I feel that more people are likely to spend money online. You could just say, oh yeah, just buy technology stocks, they'll benefit, and yeah, obviously that has been a common trend and they have rallied quite significantly. However, at the moment, there was that transition after the vaccine sell-off from these tech companies and into the value recovery plays. I think now is a genuine opportunity to take profit from these perhaps travel stocks and invest back into the more sustainable technology stocks. More specifically, I think the sectors for growth over the longer term from this period in the UK specifically is fintech or financial technology, software, video game developers, and also online retailing. And they will likely be the winners of this period as more people will likely transition to spending online, and I think this is a trend that had picked up in the pandemic and is likely going to continue as it's much more convenient. They're going to be using these various payment portals, which is where the fintechnology companies come in, and then also you have those looking to market their products online and therefore would need perhaps some digital marketing software. However, if you've been looking at the UK markets for a while, you'll know that this is hard to find. This is because the FTSE 100 and even the FTSE 250 are massively underrepresenting the technology sector, and therefore you need to dive a little bit deeper into the AIM markets, which present some risk as obviously they are smaller caps, so they have less liquidity and subsequently more volatility, and they are regulated to a lesser extent, meaning they could be more risky. However, I have found a small selection that I feel will be winners during this time period. Starting the list, we have CER or Cerillion. They are a fin technology company or a software provider for billing and payment solutions. They have an excellent balance sheet, little to no debt, and also great revenue growth. DOTD or Dot Digital provides digital marketing software towards individuals trying to market their products, and this is worldwide. They once more have a great balance sheet, zero debt, and also great profit margins. We also have TM17 or Team 17, which are the video game developers of the popular franchise Worms. They have a once more fantastic balance sheet, little to no debt, if not I think 0% debt, and excellent revenue growth. Ultimately, I believe the UK markets present an opportunity, and that's because they have been priced down so significantly. But I don't think the opportunity lies in these value recovery plays, but rather I feel that they lie in some of the gems, those that you know will continue performing well, and as sentiment boosts in our markets from Brexit being out of the way, from the pandemic being non-existent or non-effective to our economy, that's a point where I feel that more investors will put money into the markets. As an average, investors will be more willing to pay a premium in the markets, and therefore I could see a boost to these stocks. And a lot of these are much higher price earnings ratios and could substantially gain. If you're interested in how many shares of a stock you need to own in order to get £100 of dividend income, then click the card at the top right of the video. Thank you for watching. I'm Osborne Foreman. Have a great day.